Everybody, it's Dave again. This video is going to be a video that we're going to discuss the concept of how our ratings and ranking system, along with our trend and timing, can help get you out of the market by reducing your exposure slowly. The primary reason everybody wants to kind of look at this because the big thing with me is that as I said, with this particular program, the primary goals are to make sure that investors stay invested or participating in the growth of the equity market for major moves in the equity market, but then begin to rotate over to more of what we would call a tactical exposure, or begin to lower your weights as the market begins to change direction and go through a period of decline. Now, on the screen, what you're seeing is a copy of or a chart that goes back 20 years on the S&P 500. And so what's obviously pretty clear is that there is a fair amount of up and down that does occur in the market. And anybody that believes that that cycle has stopped is going to be sadly mistaken. And I stand by the fact that I still believe that the stock market has a potential decline. And I'm just going to change this chart into a logarithmic a percentage change chart, and I'm going to put this data right here so we can get a kind of a sense as to where we are. These particular moves dropped almost 40 to 50%, from their peak. And if we look at where 40 to 50% might be from this particular peak by changing this, so just have a look at this. Hang on a sec. So if we look at a 50% peak from the current levels, and we're talking about an area that's back to this particular point on the S&P 500, below where the peaks of where we were, and going back potentially to something in the 1990s. The reality is that the trading gods give us and the trading gods take us away. So the question is, though, is how do we know when the time to get out and when the time to get back in? And this is where the process of different weights within the trend and different weights within the tactical component actually can help you and play a really big deal. So at this point, I'm gonna minimize this chart. I'm gonna pull back up on the long term. So this is actually a chart. This is the chart going back to 1999 and 2000, where we can see that the peak in the equity market occurred approximately halfway through or into the middle of 2000 is what we saw, where stocks began to rotate into basically almost a 2.5-year bear market. And in this particular example, which is very interesting, and this is a very different setup from what we saw in the financial crisis. When we go and look at this, is that what we can see clearly is that this is a market that has a fair amount of trading volatility in it, and that trading volatility can be seen by the fact that our sort of generic long-based trading system is showing profit because it's above its major line. The major sort of on-off line right here is the green, and it's just touching below the yellow, and you can see this by a long and a sell and go short, and then long, profit. But what we're interested to know is what is the rating and ranking system showing us about the market going back in that particular time period. So when I look at the data, and you're not going to be able to see it from your particular screen right here, but basically in the case of the market, as the market continued to top and get higher, what we saw is that the composite ranking on the market was actually only sitting in a 4 out of 10. Okay, and it oscillated between 6 and 7, which was a buy. So this is the point right here where down at the bottom where we got a 7, which does represent the low end of the buy range. So you can buy in here, and then as we move forward, we get a rally in the market over the next month or so. Then we drop down to 3.7, which is back into what we call the trading range, which is where we would look to exit out of this. And even from a percentage, basic percentage in the ranking program, you're really at this particular point, what you're really only talking about is going from a 70% weight in equities to 37% weight in equities at that particular time. But the fact that we're showing such strong growth in the equity curve of the D2 process that we talked about, that again, if you haven't seen the video, try and watch the video on the D2 process to understand, because this is signaling that it is a market where it's advantageous for investors to be, overweighting or at least considering, tactical asset allocation shifts. But what begins to happen here is that as the market begins to top, we continue to sort of stay in that range, oscillating between 7 or 8. So we had a here's a buy that we had on the market right here it's got a rating of 8. So it's a situation where we're not sort of making a lot of money, and then as the market pops back up, we're going back. So we had an 80% weighting down there. At this point, we're now looking at a 40% weighting in the market. And as we continue to slide deeper into the sell-off, what we're seeing is that at no point do we actually start getting ourselves to the here's a 5 rating, which again is in the trading group. And what that means is if you're unprepared to trade, think of this as only a 50% weight of your equity component. So you have 50% cash, and as the market rises, your cash, now we have a rating of 1.8, and 1.8, anything below 3 is actually an outright sell in the market. And so in this particular case, at a 1.8, you would have, if you're following it in terms of cash performance, you would be 18% equities, 82% in cash. And again, you can see that as we continue to move lower on this particular scale, we once the market goes back down, there is a trading opportunity to back in at 5.3. So to put 53% of your money into the market, and then over the next couple of months, as the market rises, you're now going back to 18% of your cash. The key to understand at this particular point is that what you're seeing is that now we're oscillating back and forth between almost nothing in stocks and not much more than half of our position. And basically what happens is that we tend to stay like this between the very high end of selling and the low end, regardless of this whole process. And there's no point as we slide along this where there's anything that even gets above a 50% cash ratio. And so at that point, investors would be, if you're not a trading oriented investor, so you were in the kind of low volatility portfolio, your portfolio weighting in equities would actually be significantly underweighted. And in fact, for a lot of that particular time, your weighting in equities would actually be very close to zero. So, even though you've got a 40 to 50% decline from peak to trough in the market, and you don't do any transactions, so in a portfolio that's a low activity model that overweights the trend component and puts less emphasis on the tactical, so the buying and selling as the market goes up and down, that particular portfolio actually shuffled between ratings somewhere between 0 and about 20 to 30% in the portfolio. And it would so the amount of decline was significantly reduced. Okay, so and as I just want to show you the period from 2008, because it's a very different looking environment. So as the market, so then we have a big run in the stock market. So as you can see here we come to 2008. So in 2008 and 2000, what happens is that we have very strong growth in the equity market. So we have a real strong run up to the upside in here. And again, this is very different than what we saw at the in 2002, where the market now has now started to see some of the effects of high frequency trading, which tends to be that it, especially when we have bullish moves, it tends to reduce a lot of the volatility over the sort of 1 to 2 month period. You can see in this particular example, as we start to fall below this major curve line, which is right here. Okay, so we can see that where my mouse is. As we start to fall below that, that's a sign that the market's getting into sort of a trending environment, and that the signals that we tend to work with in here are not going to be signals necessarily that are going to work. Now, when we look at our ranking systems back in 2007, there's quite a bit of difference here. Back in 2000, we had primarily a market that was chopping up and down, and so our ratings, our composite ranking was actually, oscillating between, let's say, 4 and 7 on the up end. So there was nothing really that was on the strong end of the buy side. Whereas in 2007, it's a completely different scenario. So, in this particular case, I'm looking at, readings on the indicator of 7.3 as the market goes up, and then, our composite reading goes back. It actually goes above 10, but that's 100% invested in equities. And so, for this particular period, you're regardless of the timing aspect, you're basically in this 100% invested in equities portfolio. And then what happens is that in the summer of 2007 we begin to see sell off. So at that particular point there was about a 10% correction that happened in the market. Our data suggested that at that point you would still be in the market. So you did end up having suffering the first 10% of decline, but at that particular point you were not you still had an opportunity to potentially get out of the market on the next phase to the upside. And it's really critical for people to understand that hope springs eternal in the stock market. Wall Street is always bullish. So there's, majority of the money is run on the concept of long only. So people are generally looking to buy as opposed to sell. And that's particularly true in the age of high frequency trading, even more so today, because it's very difficult for institutions to actually acquire large blocks of stock. They've got to, unleash these algorithms that compete with other algorithms for very small amounts of individual stocks. So in this particular case, but here's sort of the critical point, is that as the market gets back up, and it actually makes new highs. So in fact, you're pretty good. So, but at this particular point, even though the market's made a new high, the rating system value at this point is actually 7.75. So it's just slightly into the bullish section, and it's we're slightly bullish at this particular point, and we get our sell signal, or so right now you're reducing your equity component to 0. So you're reducing your equity component to 75%, and then at this point we have an 80% weighting. As we start to drop, again we're probably at this point from the high we're somewhere in the neighborhood of we're 80. We still have a fairly high equity rating, and at this point we've given back peak to trough roughly about 10% at this particular point. Sorry, we gave that back earlier, but at this particular point we've given back probably about 7% of the market. So this is the point where we begin to start to see. So at this point here is the first point where we now get to what's called a trading area. So now our weighting on this rally here, which is only about 3 or 4% off the top. At this point, you're starting to substantially see asset reduction. So at this point, you now move down to a 6.8 rating on your or 68% in cash, and this number begins to continue to fall. So at this point here, we've got 70% down in this area here. The market spends a few months going sideways, so now all of a sudden we're now working as we go forward 40%. The market is now at this particular point become an outright sell at 3. So we end up actually going to about 12% equity, which is almost in the cash area at this particular point right here, which is about 10% or just a little bit more than 10% off the absolute peak. And then what we see is that we see some trading related buys, but only using only half your portfolio down in this particular area, and then going back to 13% equities at this point, just as the market starts to really break down and deliver. And then what we end up seeing is that at no point in here do we actually even break back up above sort of a 0 point, and there's no real buying that begins to occur. So the before we get to sort of the reversal of what's happening, one of the things that's really important for people to understand at this point is that your weightings begin to decline to the extent that the selling starts to pick up in intensity. So at this point, you know you've dropped your overall weighting somewhere around two-thirds to about two-thirds of your portfolio, with a 3% decline in the market, and then around about a 10% decline in the market, you pretty much reduced your portfolio almost to zero. And this is kind of the idea that when you use this tactical component and you use the trend component, that's in fact what begins to happen. And for the portfolio, for those people that don't want to be sort of looking at this at that particular point in time, this is the point where the trend rank has dropped into an absolute sell. Okay, and this is about 15% decline, and the trend rank doesn't get back to a point of rally, it doesn't get back to a point where investors are even potentially looking at trading the market until well into 2009, after the bottom has occurred. And again, we don't mind necessarily giving up some of the upside, because investors got out roughly around the 130, 135 point on spiders, and basically sat in cash to somewhere around the 100, 105 point. So first of all, in your portfolio is you protect the value of your portfolio, over time by maneuvering to cash, or at least, the 100% into cash, or by actually looking for opportunities potentially to trade the market, but with a reduced equity weighting. So this is a really good example, and again, I just want to kind of underscore what we potentially could look for in today's market, just because we continue to show that this is a market that seems to look a little bit more like 2000, where what we're getting chop that's been occurring over the past couple of months, pardon me, for the past year. And so with the equity market, is there anything that's kind of looking like it's time for us to kind of pull the chute? No, not at this particular point. We have a composite ranking as of today at 7.9%, which is basically a buy. We have a trend rank that's in the 8.5%, which is in that buy area. So at this point here, even though the expectations are for the market to kind of roll over, you're better off to wait and give back some of the upside that you have as a trade-off for should this market have like a blow off top to the upside.